Today, credit growth is slowing but still reaches another new record. Hello again, I'm Martin North, the Principal Analyst at Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today I want to discuss the latest data from both the RBA and APRA as the end of the month figures come in to December 2018. And by the way, if you get value from our posts, please do consider supporting our work either via Patreon, here is a link, or by making a one-off donation via PayPal. Again, here is a link. We really appreciate your support to help us to continue to make great content. The December 2018 data from the RBA has been released today, and credit growth continues to slow, led down by both housing and business finance. That said, total credit is still expanding, and housing credit reached a new record, $1.8 trillion. Within that, owner-occupied loans were reported at $1.21 trillion, and investment loans at $0.59 trillion. And they accounted for 32.9% of all housing lending. Credit to business was up a little to 32.8% of all lending stock. Personal credit shrank again. The share of lending for housing investment fell again, while the business mix was up just a little. Total credit for housing was an annualised 4.7% growth compared with 6.3% a year ago. And personal credit was down again, with a drop of 2% over the past year, compared with a drop of 1.1% a year before. And business credit was at 4.8%, compared with 3.1% a year back. Within the housing sector, home lending for investment purposes was at 1.1%, and for owner occupation, a still massive 6.5%. Still way higher than inflation and wages, so household debt ratios will continue to deteriorate. The monthly movements show a fall in business lending momentum and owner-occupied lending, though a small uptick in investor loans, if from a very low base. And so do APRA, who released their monthly banking statistics to the end of December 2018 today as well. Total loan stock for housing from ADIs was $1.67 trillion, up 0.23% from last month, which will be equivalent to a 2.8% annualised rate. Another record. Within that, loans for owner-occupied housing rose to $1.1 trillion, up 0.33% from November, or $3.7 billion, while investment loans rose $173 million. Overall investment loans fell to 33.45% of the portfolio. The movements show a steady decline in owner-occupied loans and a slight rebound in investor loans from a very low base. Looking at the bank's portfolio movements, we see significant variations in strategy, of Westpac and CBA still lending, especially on owner-occupied loans, alongside ING, HSBC and Members Equity. But NAB and NZ have slowed their growth and in fact dropped their share of investment loans a little in December. That said, the portfolio moves were at the margin, with CBA and Westpac maintaining their leading positions in owner-occupied and investment loans respectively. For completeness, we still show the growth in investor loans by lender, despite the APRA speed limit has now been removed. Macquarie holds the prize for portfolio growth. Investor loan growth was slowed to a crawl. And finally, we can estimate the relative growth of the banks and non-banks by combining the RBA and APRA data. It is approximate but clear that the non-banks are growing their portfolios way faster than the ADIs because although they have the same responsible lending rules, they are not constrained by APRA's capital rules. It's clear that non-banks are growing, and we estimate that for owner-occupied loans, they've grown at 16.9% over the last year, and 3.06% for investment loans, so they're both taking up the slack compared with the ADIs. But this should be a warning to regulators as risks here are rising, as households who fail the stricter banking underwriting standards turn to the non-banks, even if they have to pay a higher rate of interest. APRA needs to wake up on this one. In fact, the story overall is one of loan flow being deflected away from the Big Four to some smaller banks and to non-banks. So it'll be interesting to see if the Royal Commission report changes the game when it's released. But we can conclude the overall growth in housing lending is still building more risks into the market, despite all the hype. And credit loosening, therefore, should be resisted. If you found this useful, please do like the post and add a comment or question. I read them all. And if you have already subscribed, many thanks. I really appreciate your support. And if you haven't subscribed yet, please do so by ringing that subscribe bell. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.